What are master limited partnerships, and is an MLP right inside your investment portfolio? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardian and the Ray Financial Group. And you've entered The Vault, the Wealth Guardian video series pertaining to all things retirement and investment planning. In this episode, we're going to cover what is a master limited partnership or an MLP, how do MLPs make money as companies, how is investing in an MLP taxed, and what is a Schedule K-1 form if I do invest into this investment, how are MLP dividends taxed when I receive them. All right, so let's get into it here. MLPs are special tax classified companies that hold assets like pipelines, energy storage facilities. Essentially, they are pass-through entities which are required to pass all income and expenses on to investment partners. As a consequence of that, though, they pay no corporate taxes. This means that these are highly efficient businesses because they can skip corporate taxes. Now, what does this mean? This means large cash flows for investors, but it does require additional tax burdens for those same investors. Okay, so how do MLPs make money? MLPs make money off of their oil and gas pipelines and terminals by charging oil companies to connect to their pipeline network and send oil to the refineries all across the country. Think of MLPs like the managers of a toll road, just for oil companies. You want to use our pipeline to pump to your refinery 200 miles away? Well, that'll be 15 cents a gallon, please. MLPs make money based off of volume pumped or distributed, not necessarily the price of the oil on the open market. This is a business model that makes massive amounts of cash, which is then passed down to investors in the distribution network. So how is investing in the MLP taxed, and what is this Schedule K-1 form I'm going to get if I choose to become an investor? When you invest inside of an MLP, each year you are given a Schedule K-1 form to show all the pass-through income and expenses from your partnership inside the company. The MLP will show you your share of the business on your Schedule K-1, including the income minus expenses, capital depreciation, plus all the dividends you receive. Okay, how are MLP dividends taxed? Here's what's really interesting here. The dividends you receive throughout the year, those aren't all taxed. Only part of the dividends you receive will show up as ordinary or qualified dividends. The other part you receive, normally 80 to 90% of your dividends, are considered return of capital, or ROC. The IRS considers this a payback of your investment in the company instead of cash flow. So you don't have to pay taxes on it right now. Sounds confusing? Okay, let's get into an example. Let's say you buy one share of EPD, which is one of the largest MLPs out there in the market, for the current market price of $28.48. If you hold it throughout the year, you will receive $206 per share in dividends, with 31 cents as ordinary dividends, and $1.75 of that as a return of capital distribution back to you. So you pay the taxes on the 31-cent ordinary dividend, and then you mark your price paid per share down by the $1.75 to $26.73. So now what happens here? In the eyes of the IRS, instead of paying $28.48 for each of these shares, you only paid $26.73. Of course, like any stock, when you sell it, you pay capital gains on the sale price minus that $26.73, which is that adjusted price. So most of you on your taxes of an MLP are going to be for capital gains when you sell, not going to be paid taxes on the dividend. Now, there is a tax loophole here. The IRS says that these pass-through investments are marked up to market value inside of an estate. So if you were to die, then that share of EPD with an adjusted cost basis of now $26.73 goes to your heirs, and then the shares get counted on their taxes at current market value of $28.48. So they get the shares at that price, and they start counting their own capital gains at current market price. So the loophole here only works if you never sell your MLP. You can collect dividends for possibly up to decades, paying minimal taxes on just the ordinary dividend. Then when you pass them on to your heirs, their cost basis is marked up to current market value, wiping out that adjusted lower cost basis for you. And it's almost like those dividends that you received for all those years never happened. What can your heirs then do with the investment? Well, they've got two options. They can sell the investment shortly after you pass and pay little to no capital gains tax, since they enjoyed the step up in basis cost that we just talked about. Or they can continue to hold on to their MLPs just like you did and collect dividends, paying minimal taxes on the ordinary dividend, just like you did for decades. Lastly, you don't really want to hold MLPs in tax-deferred accounts, such as a Roth or an IRA. The problem here is that those tax benefits don't get counted if you hold an MLP inside a tax-deferred account. You're already paying very little taxes on your MLP anyway, so what does it matter if you get those dividends tax-free? So only hold an MLP in your regular taxable account, such as an individual or brokerage account. Well, that's going to wrap it up for this episode of The Vault. Feel free to hit the like and subscribe buttons below, and be sure to subscribe to catch all future episodes. And remember, sound financial plans don't create themselves.